Welcome back. You're watching Stock Picks. Today we unpack Eli Lilly, Pfizer, Novo Nordisk, and Novartis. And bringing us that analysis is Gary Booysen from Randsmith. Gary, always a pleasure. Good afternoon.
Yeah, good afternoon. Thanks for having me on.
All right, Gary, it always feels a little bit sinister to speak a pharma because, of course, all of this does rely on people being unwell. But I'm very keen to delve into these stocks with you. Which one would you like to start with?
It's glass half empty, glass half full, I suppose.
Yeah.
Pharmaceutical companies also stop people from being unwell. So, I mean, they do show like a lot of economic resilience because people take medication no matter what. And, we have an aging population. So it is, I suppose, quite an exciting sector. Should we start with the big one?
Yes.
So we can start maybe Eli Lilly.
Okay.
Market cap almost $800 billion US. Definitely the biggest we're going to talk about today.
Let's talk on Eli Lilly because, of course, Eli Lilly, they're a direct competitor in my mind to Novo Nordisk with some of the diabetes, weight loss stuff happening. But they've also always been big on Alzheimer's and the likes.
Yeah, so it's almost, I suppose the drug development goes in together hand in hand. It also, helps with, I suppose, liver conditions as well. So it's essentially the type of molecules that they generating, which is, obviously, I think a lot of people now know the term, the GLP-1 drugs. They, are marketed at a variety of things, but essentially, diabetes drugs and now weight loss, obesity drugs as well, which have absolutely taken off. And it's one of the reasons that you've seen Eli Lilly share price almost go parabolic. It almost looks like an NVIDIA share price. So up around 42% in dollars so far this year. It is trading on a hugely extended multiple. So looking at around 122 times earnings. But that doesn't actually look so bad when you look at what the EPS growth is expected to be over the next 3 years. Just 1 year out, we're expecting earnings to lift to around 140%. So that multiple going to come down dramatically. And if we just look at the Q4 earnings, last Q4 they earned $2.49 per share. We're now looking at the predicted, or the estimate at least, is at $4.50. So you basically double your earnings. You're going to halve that PE as well. So even though we have seen kind of a massive rise in the share price and the earnings and the multiple is very, very extended, it does seem to have the earnings to back it up. Looking at the underlying company, they've got a strong pipeline of new blockbuster drugs. Remember, all the companies we're talking about today, if you talk about a blockbuster drug, it means a drug that does more than $1 billion in sales. With a strong pipeline, a lot of them, the FDA has basically 3 levels of approval. If you have more drugs in the 3rd stage of testing, it's more likely that they're going to come through and be approved. More likely, you're going to essentially be able to replace the drugs that are falling off patent. At this stage, yes, new Alzheimer's technology coming through. It's kind of a lower barrier. I'm not even going to try and pronounce the drug name. It's donemab, I think. All the drug names that we're going to talk about today are very, very complicated to say. But yeah, that's in final stages of approval, and it does look like when it comes to Alzheimer's medication, specifically, the FDA actually has lower thresholds for approving these kind of drugs. So it looks like a strong prospect. A lot of people would call it very, very expensive, but I think at the moment it's expensive, almost like NVIDIA's expensive when it comes to their GLP-1 drugs, which essentially it's Zepbound is one of the things, Trulicity and Mounjaro, I think that's how you say it. All of them essentially facing capacity constraints, so they can't make enough of this drug to sell it. And then, of course, they've also got a good segment in oncology as well. And they've got a breast cancer drug coming out now that could potentially account for around 40% of sales. So strong business, expensive, but looks good.
With that said, and then let's take a look at Novo Nordisk. I think the story there is very similar. Of course, this is a Danish company there. And then maybe we can just put the two against each other for a retail investor.
Oh, absolutely. So if you look at the underlying brands, the molecule that you're talking about, the semaglutide, if they're marketed for diabetes, as diabetes medication, this is Ozempic. If they're marketed for obesity, exactly the same molecule, it's called Wegovy. So those are their brands, and the sales have just been absolutely incredible. To the extent that if you go and Google it, you'll see it is actually causing problems for the Danish central bank. This, as you mentioned, this is a Danish company, and it actually moves the krona. Now, the krona has actually strengthened because of the size of the sales that Novo Nordisk has done, and they actually have to consult with the Danish central bank, who has a peg, sort of a peg to the euro. It's under the ERM2 program, where it's allowed to fluctuate within 2.25% of the euro, and Novo Nordisk sales are actually affecting this. So, I mean, absolutely incredible success story for the company. You look at kind of the let's say the earnings forecast out 3 years. You're expecting earnings to lift, kind of between sort of 20 and 25% per year, and you're seeing the same kind of revenue growth as well. So growing really, really quickly, from a PE multiple at the moment, not as stretched as something like Eli Lilly. So looking at around 47 times earnings. It's trading just under 1,000 kroner per share. And yeah, I think. It's got if you compare it, it's got a significant advantage. I mean, Novo's been around for around 85 years, but they account for around 34% of the total diabetes market. But they account for about half of the insulin market. Diabetes market's about 50 billion, whereas the insulin market's around $15 billion, that is. So I mean, it's significantly entrenched in its respective markets, and no reason to expect it not to keep going.
With that said, if you are looking at getting on these diabetes/weight loss drugs here, considering valuations, but also maybe even the fundamentals of the business, I think Eli Lilly sounding a little bit more diversified than Novo Nordisk here. Which one do you like the most, Gary?
Yeah, so at the moment, we like both of them. We hold both for clients. At the moment, Eli Lilly actually forms part of our AI portfolio, would you believe it?
Interesting.
And there is some risk around cannibalization of the existing drugs, as new versions of the drugs come out. But I think what's particularly interesting for the sector as a whole, and specifically interesting for Novartis and Eli Lilly, and one of the reasons that they form part of our AI thematic portfolio, is that they've done a deal with Google through isomorphic labs. And a lot of the data that these, when you're looking at testing and drug development, I mean, it's incredibly research heavy. The R&D spend is absolutely enormous. It takes a huge amount of patient data. It takes a huge army of statisticians and doctors and that to analyze these results and kind of make decisions and understand whether they're safe. And I think with the kind of rise of AI, you're going to see drug development cycles, speeding up, and I think there's huge advances that are going to be made, and I think specifically that's one of the reasons that we're holding them, and we do like the sector.
With that said, let's talk about Novartis. Interesting one there. It's a Swiss company. Tell us a little bit more about why you like this one.
I don't know if I like it. I mean, like I said, I don't know if I like it as much as Eli Lilly. I think the reason that you would take the spread between the two of them, is it is a lot cheaper. So you're looking at a historic 12-month trading multiple of around 24 times earnings. It's a lot smaller than Eli Lilly as well. So Eli Lilly sitting just under $800 billion. This sitting at just over $200 billion. A little bit more room for growth potentially. The earnings, the revenue is expected to be quite flat over the next couple of years, and the reason for that is that while they do have plenty of drugs in the pipeline, it's probably a more well-diversified business. There is a large patent cliff coming in around 2026 that you need to see new drugs coming through. So drugs like Afinitor, which is their oncology, it's a cancer medication, and they've also got a multiple sclerosis drug that is coming off patent. Those account for a significant portion of the overall company sales. So that's going to drop off. Also, it is a little bit more concentrated. So about 1/3 of its sales are actually prescription branded drugs in the USA. So a little bit more concentrated, even though it is a Swiss business. And I think that does add an element of risk to it. But I think that risk is more than mitigated by the lower price multiple. The price is not quite, it hasn't quite gone as parabolic as the likes of Novo Nordisk and Eli Lilly.
Gary, when you see a patent cliff approaching, do you also want to see a ramp up in R&D? Does that give the comfort to the ability for the company to continue on a certain trajectory?
Absolutely, and I think one of the things that's it's important to see where the drug development is in the three stages, of approval, and they've got a very good late stage pipeline. So specifically, what they're targeting is oncology, which is the big one. It's where you want your drugs to be. Although, yes, at the moment, investors are all about the weight loss and the diabetes drugs. It is traditionally probably the more exciting sector from a profitability point of view. And they also have some very, very good, or very promising at least, late stage drugs in development around rare diseases as well. So that should be coming through to replace that. But again, it comes down to development, and there's added risk to that. If those drugs aren't taken up well, if there's a stalling in the approval process, if they don't, competitive, it's also a very, very competitive environment. I suppose one of the things that you can say about a company the size of Novartis, or really any of the companies that we're talking about today, you can think of them almost as, even though it's a pharmaceutical company, you think of them as big tech companies. And what happens is a lot of the small biotech firms, a lot of the small firms that break away and they develop, these businesses have the scale to roll out the drugs, at stage. So even if you do see kind of a lack in the pipeline, there's always the ability to do M&A, find drugs that are becoming successful in smaller businesses, buy them out, and then offer those smaller companies an ability to market the drugs on a large scale. The likes of Novartis is going to have essentially the ability to ramp up and achieve the economies of scale in the drug production that a smaller firm won't. So as much as the pipeline is very important, and in-house development and R&D spend is very important, also the ability to source and find good business partners that you can buy in and market their drugs is also critical.
With that said, let's talk evaluations for Novartis and how that fares for you.
Yeah, like I said, Novartis is not particularly expensive. So if I look at Novartis, 1 year out, we're expecting the P multiple to drop to around 14, and if you take that out to 3 years, you're expecting earnings to drop to around at least the price earnings ratio to drop to around just above 12. Again, and if you look at something like the price to sales ratio, a little bit more extended. I mean, if you compare something like Novartis to Pfizer, for example, like you are paying a little bit more per unit of revenue. But even so, I mean, you're looking at price to sales ratio sticking at around, call it 4.5 over the next 3 years, because you have got quite a solid top line. You're not expecting a big fluctuation in the top line of Novartis, that is.
With that said, let's talk about Pfizer. We stopped hearing about Pfizer, and I was relieved because it meant COVID had waned or disappeared here. But of course, I think COVID-19 vaccines do play quite a bit of a role in the story for Pfizer.
Yeah, absolutely. And I think they overinvested in the COVID vaccine as well. And that's one of the reasons that you've seen such a dismal performance from the share over the last little bit, which I've kind of also, didn't we see this coming? But I'm surprised that the market was as surprised as the market was. And I think out of all the stocks that we're talking about today, I think, it's probably one of the more exciting stocks as a recovery play. So we're expecting in the next reporting we're going to see a massive recovery in earnings as well. So from Pfizer, so also trading on a trailing 12-month PE of around 78, so also looking quite expensive. But you've got to consider that the EPS line that it printed last time around was 37 US cents. That's expected to lift to $2.35. So you're getting this massive uplift in earnings, which is going to essentially 1 year out you're talking about a 1 year forward PE of around 12.5. So probably the cheapest company of any company that we're looking at. Yet, if you look at the actual revenue line, I mean, we're expecting it to make just over $60 billion US dollars, over the next, let's say, over the next year, when it comes to report its full year results, at least. Now, you're talking about a company with a market cap of $160 billion, making $60 billion in revenue, and they're putting through about $4 billion in cost cuts as well. You compare that to something like Eli Lilly, which is sitting at that $800 billion valuation, and they actually make less revenue. so it's it is very cheap. I mean, Pfizer's very cheap, and I think with being, I suppose, so with the COVID vaccine, kind of winding down and the overinvestment and the requirement to do a lot of cost cutting and a lot of rethinking, I think it fell out of favor with investors, and I think that can turn around very, very quickly. If you have a look at it, their operating margin, we expect the operating margin to return to around 30%, which is in line with their pre-pandemic operating margin. It was kind of almost a windfall for the company, but then quickly turned into a hangover. It was that sugar rush, or it was a big party and then a hangover for the company. And I think that is working its way through the system at the moment. So with the cost cutting, with the return to kind of more normal profitability, with the big uplift in share in earnings, I think you might see the share price doing fairly well. I mean, the share price at the moment is trading just a touch under $30 per share. I mean, that's down almost 50% from the heady heights of around $60 a share. But you've also got to remember that the story is not fully told by the share price. This is still sitting on almost a 6% dollar-based dividend yield, by far the highest dividend yield of any of the companies that we're talking about. And as I said, it's big, it's still big, and it's still beautiful. It has an incredible sales force. It has those economies of scale to roll out drugs that other companies just can't do. I think out of all four that we've talked about today, it would probably be Pfizer. That's my pick.
Okay, and then let's rate the other ones, 2, 3, and 4 for that. And if somebody is looking to get a little bit of this, a little bit of that, I know you probably can't choose between Novo Nordisk and Eli Lilly, so that could be tied somewhere. You don't have to choose.
It's a very difficult. I think probably a spread of both of them. But like I said, Eli Lilly, I think in portfolios at the moment, I think it's exciting. There's a lot of momentum behind the stock. So I'd probably take Eli Lilly over Novo Nordisk. Novo Nordisk, again, also a strong growth stock, but I mean, we're talking neck and neck here, but maybe with Eli Lilly edging it out. And Novartis, I think, interesting, a lot cheaper, but probably in fourth place, but definitely still a buy.
Wonderful, Gary. A pleasure having you today, and also taking us through these companies and the complexities, because it's a very interesting industry. Thank you so much for your time today. That was Rand Swiss's Gary Booysen.